Hi, I'd like to open a certificate of deposit or CD. Sure, what type would you like? I heard 12-month CDs are usually good. Currently, our rate is 4.5%. Whoa, that's a great deal. I'll deposit $10,000 into one. I need to close my CD to have funds to buy an I-bond instead, which has a higher interest rate. Now I have to forfeit 60 days of interest. You know, if you wanted more flexibility, you could have opened a no penalty CD. You can withdraw all of your funds at least 6 days after opening, and you get to keep all of your accrued interest. What? There's such a thing? I thought all CDs lock in your money and you have to pay early withdrawal penalties. I should have asked Alex first. Hello there. This is Alex with Sinspiration, where I inspire you to develop a growth mindset. In a high interest rate environment, it's bad for businesses, taking on loans, and your spending and bills, but it's excellent for your savings accounts. Last month in March 2023, we had 3 bank failures: Silvergate Bank, Silicon Valley Bank, and Signature Bank. Somehow all 3 start with S. This is scary stuff, because if these banks fail, will other banks fail? Will your or my bank fail? You can paint a picture in your mind of what happened in the 1930s. Crowds of people lining up at their bank, demanding their money, only to find out that the bank didn't have enough money to pay everyone back. Yikes. But rest assured, when you deposit money into an FDIC insured account, you are insured up to $250,000 in checking, savings, money market, and CDs. That's a high cap, and this applies to each institution, meaning you can spread your money out across the different banks to put your eggs into different baskets. High yield savings is the main upgrade from a standard checking or savings account, which gives you only 0.01% interest. You're likely to be getting 100 times more interest, usually in the 1 to 3% range. But these days, with the Fed increasing interest rates so much, we are seeing over 3% interest on high yield savings accounts. Ally Bank, which is what I use, is offering 3.75% at the time of the creation of this video. When I opened my high yield savings account in 2016, I was making 1%, and I was happy. It was much more than my checking account. When it increased to 2%, I was really happy. And now 3.75%. That's a steal. Friendly reminder that you can only make 6 withdrawals each month. Any more than that will cost you $10 per transaction. High yield CDs allow you to lock in an interest rate for a fixed amount of time. Typically, the longer the term, the higher the interest rate. CDs 12 months and longer usually give you higher interest rates than that of high yield savings. For high yield CDs, you have different options where you can select different months. So right here, 12 months is currently offering 4.5%. As you select the months that are shorter, the interest rate decreases because you're committing less time to this bank to hold on to your money in the CD. But as you increase towards the CDs that take more time, such as 18 months, 3 years, and 5 years, you'll notice that they are higher than the standard 12-month. But here you see that 3 years is actually less than that of 18 months. And this typically happens because banks might predict that rates will go down and they don't want to lose money themselves. And so that's why they have lower interest rates for their CDs. Typically, I open 12-month CDs. It's long enough that I get a competitive rate, and every year it allows me to repurpose my money. Ally Bank also offers a 0.05% loyalty reward if you renew your CD. Keep in mind, for early withdrawals, you usually have to withdraw all your funds. Partial early withdrawals are possible with some banks, but most banks like Ally do not allow it. You also can't add more money into a CD once you've opened it. Once that money's in, it is locked for the set period of time until you withdraw everything and close the account. This is the main trade-off between a CD and a high yield savings. When you withdraw early, there's almost certainly a fee or penalty. Ally Bank charges 60 days of interest on CDs 24 months or less. Longer CDs have higher penalties. If the Fed lowers interest rates, then good for you. You still keep the high interest rate until the end of your CD's term. But if the Fed increases interest rates, which is what's happening now, you're stuck with the rate you have on your CD unless you close it by paying an early withdrawal penalty to use that cash to open a new one, or if you have extra cash, open a second CD. In the past 12 months, the interest rate increased so quickly that I actually closed my 1.25% CD by paying the early withdrawal penalty to move all of my funds to high yield savings that was giving me 2.25%. That's a whole percentage. I calculated I would make more money with the new rate even if I paid the 60-day interest penalty. If the interest rate on high yield savings or new CDs is much higher than the interest rate of your current CD, then it may not be a bad idea to just take the penalty. Another reason why I like 12-month CDs. Raise your rate CDs allow you to increase your interest rate during the middle of your term. You can increase your interest rate once for a 2-year CD or twice for a 4-year CD. I have not opened this type of CD before, but it can be beneficial if you expect interest rates to increase in the foreseeable future. But I still don't recommend a raise your rate CD because 2 years and 4 years are long durations. You might need the money during this time, or the interest rate does increase and you might as well just open another 12-month CD. Your starting interest rate is 3.75% here, same as high yield savings, but much lower than the high yield CDs. The 18-month, 3-year, and 5-year high yield CDs look more attractive than the raise your rate CDs. This leaves the third and final type of CD called a no penalty CD, which allows you to withdraw early without penalty and keep the accrued interest. Higher interest rates than those of high yield savings and the flexibility to withdraw seems too good to be true, right? Don't forget, if you want to withdraw your money from a CD, you usually have to withdraw all your money. That's how a CD works. I'll use Ally Bank's 11-month no penalty CD as an example. As of the making of this video, the interest rate is 4.35%, just shy of the 4.5% for a 12-month high yield CD. 6 days after funding your account, you can withdraw all your funds, including the accrued interest, with no penalty. This is exceptionally useful if you open this type of CD and the interest rate increases. Instead of missing out, you can close this no penalty CD and open a new one. Repeat this until the interest rate stops increasing. And there's the power of compound interest if you include the interest you have earned to fund your new account. The gap between a 12-month high yield CD and the 11-month no penalty CD is just 0.15%, or about $15 for every $10,000 if you calculate using simple interest. If you are confident that the interest rate will increase by more than 0.15% in the year, then a no penalty CD is for you. Interesting story. In the beginning of March, Ally Bank was offering an 11-month no penalty CD at 4%. And so I opened one. 1 week later, the interest rate shot up to 4.75%, probably due to the Silicon Valley Bank event. And so what I did was I closed this 4% account and then reopened one with 4.75%. The Fed has been slowing down on increasing the interest rate, but still increasing. So it's beneficial to you to keep your CDs flexible, or at least keep extra cash to open multiple CDs. When the Fed starts to cut the interest rate, the high yield CDs will be more favorable because you'll want to lock in a higher interest rate for a longer period of time. In short, pay attention to the news and keep a lookout for your bank's interest rates for CDs. I love owning stocks more than cash and bonds. But in times like this, where the chances of recession are increasing, we're in a bear market, and the interest rates are so high, high yield savings and CDs are attractive. You eliminate the risk of market volatility and uncertainty in the stocks of companies you own by being guaranteed interest payments. And each FDIC insured bank covers you $250,000, which is more than enough. It's a good idea to put your emergency fund and extra savings into a high yield savings or a CD, depending on the flexibility you want in withdrawing them. The iBond is an alternative to high yield savings and CDs, which I recommend more because of its higher interest rate and a component that matches inflation, though there are more withdrawal restrictions. You can learn more about iBonds, high yield savings, and CDs in my older video. Hope you enjoyed this video. Hit that like button and comment below with what high yield savings and CDs you're getting at your banks. Don't forget to subscribe to my channel to get updates on new videos, and also check out my page for more content on how to grow your mindset. You've been Sinspired today. Get that free money from interest. Cha-ching!